What if the next market crash isn't coming from where everyone expects, but from the places the big banks don't want you to look? Right now, there are quiet warning signs flashing inside the U.S. banking system, subtle signals that the financial elite understand perfectly, but that most retail investors completely miss. Today, I'm going to show you what those hidden warnings are, why the banks are keeping quiet, and how you can actually turn this coming crisis into an opportunity. By the end of this video, you'll understand exactly what could trigger the 2026 market crash and how to protect and grow your wealth when it hits. Let's dive in. The bank's rare warning signals. For months, several top banking executives have been dropping cryptic remarks about uncomfortable risks building under the surface. Jamie Dimon, the CEO of J.P. Morgan Chase, recently said he's far more worried than most analysts about a major U.S. stock market correction, placing the probability near 30%, when others say barely 10%. When a banker that powerful goes on record with that kind of number, it's not random. It's calculated. At the same time, international regulators, like the IMF, have warned that global banks are heavily exposed to a shadow world of lending, private credit, and hedge funds, estimated at more than $4 trillion. That means if those private loans start to default, the shock could ripple directly into the banking system. And here's something most people missed. The Federal Reserve recently injected around $125 billion into U.S. banks over just 5 days. They didn't make a big announcement. They didn't hold a press conference. It was done quietly, but it shows that banks needed cash, fast. When central banks quietly open the liquidity tap, it usually means they're seeing stress in the plumbing of the system, long before the public sees it. These are not normal events, and yet the headlines barely mention them. What the banks are hiding. So what exactly are banks trying not to talk about? There are 3 layers of hidden risk that explain why they're staying quiet. First, hidden exposures. Banks love to offload risk into what's called the non-bank financial sector, private credit funds, hedge funds, and shadow lenders. It keeps their official balance sheets looking clean. But here's the truth. Many of those shadow lenders borrow money from the same banks. If a major private credit fund fails, the losses can boomerang right back into the banking system. Second, liquidity stress. The Fed's recent cash injections weren't charity. They were lifelines. Some banks, especially regional ones, are struggling with expensive funding and unrealized losses on their bond portfolios. They can't say that publicly because confidence is everything in banking. Once people doubt a bank's stability, deposits can flee overnight, and the panic becomes real. Third, valuation and debt fragility. Corporate debt in the U.S. has climbed to historic highs. Many companies borrowed heavily during the zero-interest era. Now, as rates stay higher for longer, that debt is becoming harder to service. If earnings fall or the economy slows, defaults will rise. And when defaults rise, bank balance sheets take the hit. So while investors cheer record stock prices and booming AI companies, the foundation underneath, the financial system itself, is quietly creaking. Why 2026 could be the breaking point. Let's talk timing. Why do so many analysts point specifically to 2026? Because that's when multiple fault lines converge. First, interest rates. The Fed is expected to begin cutting rates after 2 years of aggressive tightening. Historically, the first rate cut after a long hiking cycle often signals economic weakness, not strength. Second, valuations. Technology stocks are trading at valuations not seen since the dot-com era. Earnings would need to grow massively to justify current prices, but growth is slowing. Third, corporate debt refinancing. Between 2025 and 2027, hundreds of billions of dollars in corporate loans and bonds will need to be refinanced at higher rates. That will crush profits and strain balance sheets. Fourth, banking exposure. Regional banks in particular still hold commercial real estate loans that are deeply underwater. Office buildings are half empty in major U.S. cities, yet those loans remain on the books at near face value. Combine these with global uncertainties, trade tensions, inflation shocks, geopolitical conflicts, and you have a perfect setup. One unexpected spark could ignite it all. It doesn't have to be a Lehman Brothers level collapse. It could be a few mid-sized banks reporting sudden losses. It could be a big hedge fund default, or a major company failing to roll over its debt. Once confidence cracks, the contagion spreads fast. And remember, most investors won't see it coming, because banks and regulators will try to contain panic. How a crash like this unfolds. Every crash follows the same emotional cycle. At first, denial. Markets wobble, analysts say it's just a correction. Then fear. Prices fall faster, news headlines turn red, and retail investors start selling. Then panic. Selling becomes forced. People want cash at any cost. Finally, capitulation. The point where everyone believes it's over forever. And that's exactly when the biggest fortunes are made. If you study 2008, or even 2020, the pattern is the same. The crash wipes out leverage and weak hands. Then, once liquidity returns, the recovery begins. And those who bought quality assets during the panic double or triple their wealth. But the key is preparation. You can't wait until the headlines scream crash to get ready. You need your plan now. How to prepare and profit. Step 1. Build liquidity. Cash is optional in a bull market. It's essential in a crash. Keep a portion of your portfolio in short-term treasury ETFs or money market funds. This gives you flexibility to buy when everyone else is forced to sell. Step 2. Create a watch list of quality assets, not meme stocks, not speculative hype. Look for companies with real earnings, strong cash flow, and low debt. Think blue-chip stocks or diversified ETFs like the S&P 500 or NASDAQ 100 at discounted prices. Write down the price levels where you'd love to own them and wait patiently. Step 3. Watch the banking system closely. Follow key metrics like credit spreads, bank stock performance, and sudden liquidity operations by the Federal Reserve. If you see banks drawing emergency funds again, that's your signal that stress is rising. Step 4. Avoid unnecessary leverage. Debt magnifies returns in good times, but destroys them in bad ones. When liquidity dries up, leveraged positions get liquidated first. Step 5. Control your mindset. This might be the most important one. During crashes, emotions destroy more wealth than the market itself. If you can stay calm while others panic, you already have an edge. Remember, every bear market in U.S. history has eventually turned into a bull market. Not some of them, every one of them. The hidden advantage of awareness. Here's what separates smart investors from victims. Information. When banks quietly prepare for a storm, they're not trying to protect you. They're protecting themselves. They reduce exposure, raise cash, and reposition before the chaos hits. But you can do the same, if you know what to look for. Understanding that these warning signs exist is already step 1 toward taking control. Imagine being one of the few who bought during the 2008 panic. Imagine buying quality tech stocks in 2020 when everyone thought the world was ending. Those moments don't feel safe, but they're where real wealth is built. The 2026 environment could be the next version of that story. Most people will freeze. A small percentage will act. And that small percentage will come out far ahead. Building your 2026 game plan. Let's recap your action steps so you're ready long before the headlines hit. 1. Keep cash on hand. Liquidity is power. 2. List the assets you believe in for the long run. 3. Follow financial conditions, especially any sudden central bank interventions. 4. Stay out of high-leverage bets and speculative bubbles. 5. Prepare mentally for volatility, and view fear as opportunity. If you follow these 5 principles, you'll not only protect yourself, you might position to profit from the very panic that wipes others out. Because remember, the markets don't reward fear. They reward patience, discipline, and preparation. Closing thoughts. The big banks aren't lying to you outright. They're simply not telling the whole story. They know there are cracks forming, and they're quietly fortifying themselves before the storm. You can do the same. So when the news in 2026 suddenly shifts from optimism to chaos, when the charts turn red and analysts start shouting, "Nobody could have seen this coming," you'll know better. You'll recognize the signs. You'll have cash ready. You'll have a plan. Crashes don't destroy wealth. Panic does. Preparation builds it. If you found this breakdown helpful, make sure you subscribe for more weekly updates on the markets, the economy, and the truth the banks won't tell you. And let me know in the comments. What do you think will trigger the next crash? Until next time, stay sharp, stay ready, and don't let fear control your financial future.